All right, hi everybody. Welcome back to week 6 of NYU Shanghai TAMID education. This week we're going to be talking about the first derivatives options. So we'll go over the basics of options, the types, the valuation, and the strategies. So first off, we got the basics. So the history of options, there was an ancient Greek philosopher named Thales of Miletus. He purchased the right to rent multiple olive pressers before a predicted increase in olive harvest. And when his prediction was actually correct, he exercised his right to rent out all the olive presses available, allowing him to receive a substantial profit. In an options contract, there are two parties. There's the seller who writes the option and the buyer who holds it. The seller sells an option contract to the buyer, accepts a premium, and assumes obligations of the contract specifics. The buyer pays premium to the seller and gets the option to buy the underlying asset from the seller during the period. Most of the time, the underlying asset will be a stock or maybe a bond, but in US markets, it's primarily just stocks. So we'll go over some basic terminology. When you exercise an option, you invoke the rights contracted. So essentially that means you're gonna, if the contract says you're gonna buy 100 shares at a certain price, if you exercise it, you'll buy the 100 shares at that price. The exercise price is also known as a strike price, is a price at which the buyer can purchase or sell the underlying asset. The expiration date is the date at which the rights to the exercise of the option cease to exist. And the premium is the price of the option. So the characteristics is the trading platform first. Like we'll start with the trading platform. Options, just like stocks and other securities, are openly traded on exchange markets, and it's usually between two private parties. There's two exercise types. The first one is an American auction, and that's essentially you can exercise at any time before the expiration date. So if you assume a huge profit and you don't want to risk it going back down, you can exercise that before the expiration hits. And there's European options, which can only be exercised at the date of expiration. So the types of options. So there's first option is a call option. That's the right, but not the obligation to buy an underlying asset during that particular period of time. When you're buying a call option, you buy a call option when you speculate that the stock price will go up, and you pay the premium. If the stock price does go up during the expiration period, the buyer will exercise the option in an American option and they'll earn a substantial profit. Here's a graph that explains the payoff from the premium once it hits the strike price. It goes up exponentially over time. So the seller will receive a premium when a call option is sold. If the stock does not go up by the expiration, the call buyer will not exercise the option and seller will get the premium as net profit. If stock prices go up and buyer exercises the option, then the seller has to assume the obligation to sell the stock with the exercise price. Seller will bear a loss that is equal to the buyer's net profit. So the other type of option we have is put options. A put option is the right but not the obligation to sell an underlying asset during a particular period of time. In this case, a put buyer will speculate the stock price will go down, so then they buy a put at the premium. If the stock price does go down by expiration in an American option, the buyer will exercise it before expiration and they'll earn another substantial profit. Here's a graph. As you can see, it's going the opposite direction from a call, like opposite axis from a call option, but it does have a similar trend where once they reach the strike price until expiration, the profits and the payoff will increase exponentially. The seller will get a premium when put option is sold. If the stock price does not go down to the expiration, the put buyer will not exercise the option. The seller can get the premium as net profit. If the stock price does go down and the buyer exercises the option, then the seller has to assume the obligation to sell the stock with the exercise price and bear a loss equal to the buyer's net profit. So here's a payoff from writing a put. So becoming a seller, essentially your profits increasing until someone exercises it at the strike price, and then it just levels off. All right, so now I'll get into the different types of option strategies. So there are multiple variables in options, just like investment goals, anticipation on asset movement, and risk level. Options are widely used for hedging your portfolio, so to mitigate risk. And there are numerous strategies out there when buying options in order to maximize the gains or whatever you're trying to accomplish with the investment. So the type of strategies, there's bullish strategies, bearish strategies, and neutral strategies. If you recall, we went over the difference between bullish and bearish a while ago. So a trader expects the price to go up, so he's going to buy a call option. And the most bullish strategy is just a simple call option, and that's just by expecting the price will go up. A moderately bullish strategy would be the target price for the bull run. Target price for the bull run and utilize bull spreads to reduce costs, so the maximum profit is actually capped. And mildly bullish is make money as long as the underlying asset price does not go down by the expiration date. So if you want to be really bullish, you'll sometimes see the price of the option decrease, and if you're mildly bullish, you'd sell it. If you are very bullish, you'd hold, assuming it's going to bounce back up. So the bearish strategy, this is when you expect, again, it's going to go down. So then the most bearish strategy is just buying a put option. The moderate strategy is the target price expected to decline, so you reduce the bearish spreads to reduce cost. Again, the maximum profit will be capped. Mildly bullish is as long as the price does not go up, you'll get rid of it by the expiration date. So neutral strategies. This is when a trader does not know what movement to expect for the underlying asset price. It's also called non-directional strategies, which means the profit does not depend on underlying stock price going up or down. Correct neutral strategy to employ depends on the expected volatility of the underlying asset price. So now to end, we'll go over some common option strategies that you can utilize in your personal investment portfolios. So there's the covered call strategy. So the main steps are to purchase the stock first, you sell a single call contract, and then you wait for the call to be exercised or expired to realize the profit. This way, you can make cash on the price movement going up in the stock itself on top of the option. There is a high risk because there's no protection if the stock goes down. So you will lose money on your purchase of regular stock and also the option if it does go down. However, also the maximum profit is limited. Sorry. So next we got the straddle strategy. So the main steps is to buy both a call and put at the same strike price at the same expiration. As trade begins to move in one direction, the trader sells the other. We should use this when the trader does not have a clear sense of which direction stock price will move. So essentially, if you're a neutral trader and you're trading neutrally, you would use a straddle strategy. The goal is for the underlying asset to move far enough, and winning leg of the position makes more money than the losing leg costs. And then we have the strangle strategy. This is where you buy, it's similar to the straddle strategy, except you buy the call and put at the same time with different strike prices. As the trade begins to move in one direction, trader sells the other. We should use it where they also don't have a clear sense of directional move, but they believe the stock will be highly volatile. So if you assume that it's just, it could go up or down without really any pretense, you would use this strategy in order to maximize your profit. And the goal is similar to the goal of the straddle strategy. So lastly, we'll do the call spread. This is a very low risk option strategy. And what you do is you purchase a single option at money call contract. You sell the single in a money call contract, and then you wait for the price to move above the long call strike price plus the long call premium. And then you exercise a long call to make the profit. There's low risk because the maximum risk is equal to the initial debt taken when entering the trade. So you can only lose as much as you put in initially, unlike the straddle strategy. And then we have the put spread to end. Yes, there we go. It's similar to a call spread, except you're expecting the price to go down, not go up. However, there is a medium risk because price can go down exponentially. So not exponentially, but you can lose quite a bit of profit. In the medium, the risk comes from the difference between the long and short put strikes prices minus the initial credit. So the initial credit is the maximum profit one can attain with the strategy, but the maximum loss is exponential. All right, and that was it for this week. Thank you guys for coming by. I will see you next week, and we're going to go introduce REITs and other types of trusts like ETFs and mutual funds. Have a good one.